Back in high school, I ran cross country and track. And in my early cross country meets at the end of the race, parents of my friends would come over and they'd say, "Great job, Joe." And I'd say, "Well, it was okay. I stumbled out there in the second mile. Didn't feel good. Got a little pain in my side partway through. Kind of had trouble with that headwind going up a couple of those hills. I probably could have done it better. A little out of breath." And they'd look at me and go, "Oh, okay." And as we're walking away, I remember my dad one time finally saying to me, "What was that?" And I said, "What are you talking about?" And then my dad said, "All these people wanted to do was compliment you. That's all they wanted to do. And your job, your only job, was to say thank you." Live from the apartment over Uncle Jack's garage while the basement's being renovated. Hey there, stackers. I'm Joe Seul-Sehy, Average Joe Money on Twitter. Welcome back to Money in the Morning. It's the show where we take not one, but two headlines ripped from the popular press. We not only read them like some shows do, no, we go the extra mile, and we even talk about what they mean for you and your money. And then, as if that's not enough, at the end of the show, we take both of these headlines, pop them together. We send you home with what's called the big idea, and that's Money in the Morning. Money in the Morning is brought to you by the Stacky Benjamins tour this week. Some of you that listen to this a lot, you're getting sick of me talking about the tour, but we're going to do it again today because we're getting close, and it's exciting as I'm meeting with everybody who's involved in the tour. I think we have 18 different people coming on stage at various points in Orlando. We're going to be in Orlando, Kansas City, and in Detroit, playing the Improv in Orlando and Kansas City and the Go Improv Comedy Theater in Detroit. For tickets, stackybenjamins.com/tour, and I hope that we see you in those three cities. All right, you've got places to go. We've got things to do. So, Laura, why don't you kick this party off?
Here are today's Money in the Morning headlines. Ready, set, go.
Ready, set, go. Thank you, Laura. Our first piece comes to us from CNN Money, and this is written by Chris Isidore. What's killing Sears? The piece says its own retirees, the CEO says. And Chris writes, CEO and primary shareholder Eddie Lampert has another idea about what's to blame for Sears' problems. Is it Amazon? Is it bad management? Nope. He says it's the company's own retirees. Sears turned in another bleak quarter earnings report on Thursday, and Lampert complained about the billions of dollars that Sears owes its former employees through pension plans. Lampert said Sears has paid almost $2 billion into pension plans in the past 5 years and $4.5 billion since Sears and Kmart merged in 2005 to form Sears Holding Company. SHLD is the ticker symbol for that. The company pays retirees about $300 million a year, filings show. If Sears could have put that money into operations, quote, we would have been in a better position to compete with other large retail companies, many of which don't have large pension plans, Lampert wrote in a blog post. He also quoted the, quote, very difficult environment for retailers, but he said Sears has been significantly impacted by pension obligations. Many other analysts have blamed Lampert himself for Sears' misfortunes. They say he made bad decisions about marketing, didn't invest enough in stores, and didn't commit to selling online. Americans' increasing preference to buy online and at big box stores rather than malls is a major problem for the company. Sears has lost $11.7 billion since its last profitable year, way back in 2012. Lampert's right that the company's at a disadvantage because it once had traditional pension plans, which pay a fixed monthly benefit to retirees as long as they live. Most businesses today offer what's known as a defined contribution plan, such as a 401k. Sears ended its pension plans in 2006, but longtime employees and retirees are still entitled to benefits they accrued while the plans were in effect. Sears, once the nation's largest employer, has an estimated 100,000 retirees still eligible for benefits under the pension plans, according to a federal regulator. By comparison, the company had only 89,000 employees as of February, and many of them have since left the company because of store closings. Sears is required to make contributions to pension plans under rules set by the Pension Benefit Guaranty Corporation, which provides benefits to retirees whose companies and pension plans go bankrupt. When pension plans are severely underfunded or when a company is at risk of bankruptcy, both of which are the case for Sears, the PBGC sets stricter rules. For example, Sears is getting about $900 million by selling its Craftsman tool brand to Stanley Black & Decker. Under a settlement with the PBGC, Sears must contribute about $250 million of that into its pension plan. Sears is trying to sell its Kmart appliance brand as well, and Lampert has offered to buy that for $400 million, though through a hedge fund he controls, but no deal's been reached. One reason could be that Sears needs to work out an agreement with the PBCG on how much of the money would go to pensions. How ugly is that for Sears? It's interesting when you read this stuff about Sears. Let's start off with pensions. Let's not even talk about Sears at first. Let's just talk about pensions, shall we? Because pensions in America, if you've got a pension, you can see here again that the writing might be on the wall. Sears is very much trying to get out from under this pension issue. Eddie Lampert writing a blog post. Why do you do that? You do that hoping that more people will notice. He's starting to beat the drum saying this company in America, company's been around a long time. They cannot stay in business if we pay out all these people. And yet, when Sears had this pension, that was part of the promise, wasn't it? A pension is a guaranteed income for life. And the funny thing is, if you've got 89,000 people working at Sears and 100,000 people who no longer work out at Sears but are eligible for a pension, what does that say? It's another statistic or another, I don't know, more anecdotal evidence. People are living longer. People are living for a long, long, long time. Our Sears store closed here recently in our mall in Texarkana, but one of many, many, many Sears closings. And yet, let's transfer over to the Sears part of this. So what do we think? Well, number one, Sears selling off their assets. They got rid of Craftsman. Now they're getting rid of Kenmore. What is Sears? Like if Sears isn't Kenmore and Craftsman, why do you go to Sears versus any place else? And if the CEO isn't focused on a better store experience, which if you've been to Sears recently, I don't think there's anything special about the store experience. What is he really focusing on? And to blame it on the pensions. The key with any purchase, and when Eddie Lampert bought the company, he knew how many pensions he was responsible for. And as they've made cuts to stores, he knew what the issue was with his pension. Like this whole pension thing didn't sneak up on him. Oh, I got to pay a pension? Didn't sneak up on him. It happened from the very beginning. So what's the point here? There's a few points, but the big one is whether you make money or you lose money on a transaction is usually determined right at the transaction point. Eddie Lampert knew what he was getting into when he was buying. I'm in the middle of maybe, well, not in the middle. I'm at the beginning stages of maybe buying a house. And we're thinking about the purchase price of this property that we're buying. And the key point is not about a renter to put in it. It's not about what income I make off it later. The key point is at what price point I buy this property. Eddie decided to buy Sears back in the day. Decided when he was heading up Kmart. He decided first to buy Kmart, decided then to merge Kmart and Sears together. Now he says he's got this huge problem. Whose problem is it? It's Eddie's problem because Eddie's known from the very beginning. And it's the same for you and I, right? You put something on a credit card, you got to pay that credit card off later. All of a sudden waking up one day and going, I can't do anything because I got $30,000 of credit card debt. Whose fault is that? You had it all along. As things change, the more they stay the same. That's our first piece. Let's say hello to everybody hanging out with us today in Facebook land. We do have Bethany is here with us. And Bethany, I don't know. So Bethany is half of the Money Mill House. Oh, and we also have Ellie K here. Bethany and Ellie are going to be with us in Orlando. They're going to be helping us answer listener questions. But they are the Money Mill House team. And I'm a guest on the Money Mill House podcast. So go listen to even when I'm not, it's a better show when I'm not on it. So make sure you go listen to Money Mill House. But Bethany and I were talking earlier about this event we have coming up called FinCon, and Bethany is going to be the MC, and we were going to do this torch passing thing where I was going to dress in 70s short shorts and pass the torch to her, and they for some reason shut that down. I can't figure out why that's the case. And Bethany says, that would have been amazing, Joe. You can pass the torch to my heart. Oh, that's fantastic. Ellie says, love how your show gives us the big idea. Well, Ellie, we swing for the big idea. So there it is. Peter's here. We've known Peter for a long time, but Peter, I don't know that I've seen Peter hanging out with us during the live recording of this. Peter says, you do go the extra mile. I always thought your intro was pre-recorded. Well, it is pre-recorded. I just move my mouth at the same speed as the, I'm like a lip syncer, like Milli Vanilli. Does anybody know who Milli Vanilli is anymore? I don't know. Victor's here. Chris is here. Chris says maybe everyone will sell their Bitcoin and try to flip some Sears stock shares before the eventual liquidation. That, what could possibly go wrong there? Daryl is here. Daryl said he's tuning in from Phoenix today, all the way across the country, from where he usually is. Michael's here. Michael asked if we're planning to stop by Richmond, D.C., Baltimore anytime soon. I'm hearing rumors that a conference I go to might be in D.C. next year. And if it is in D.C., we will, depending on how well these live shows go this year. And so far, it looks like it's going to go well, Michael, but we may be doing a live show a year from now in the D.C. area. Should be a good time. And then Victor says, you can do that outfit on Facebook Live. Do they shut you down if you're wearing short shorts on Facebook Live? I mean, because you can only see my collared shirt. Like, you don't even know if I'm wearing pants today. So, a little spoiler alert, I am. But sorry. I just ruined. I should have said, spoiler. I did say spoiler. All right, let's move on to the second piece instead of continuing that weirdness. Second one comes to us from Jeff Benjamin over at Investment News. Jeff is talking about the stock market and its weird time in stocks. I mean, for the past, almost 5 years, we've been talking about this stock market finally going down, and you're seeing investor behavior get more and more and more bearish the longer this goes on. And yet, the stock market continues to wring out more returns. But let's read. Jeff Benjamin writes this piece that says, advisors warn against fleeing stocks in favor of bonds. Investors continue to favor fixed income strategies over equities, which is contrary to what most financial advisors consider prudent at this point in the market cycle and suggests an anxious investing universe. You feeling anxious? I got to say, I'm not really feeling anxious. Like, I know it's going to come, but maybe that's just my longer term point of view. I don't know. We'll continue. The latest data from ETF.com shows that more than half of the $4.2 billion that moved into U.S.-listed ETFs in the week ending last Thursday went into bond strategies. 3 of the 5 most popular ETF strategies last week were bond funds. The $34.5 billion iShares iBoxx investment grade corporate bond ETF, ticker symbol LQD, had more than $756 million in net inflows last week. Meanwhile, the biggest outflows, totaling $2.1 billion, were experienced by the $271 billion SPDR S&P 500 ETF, ticker symbol SPY. And by the way, I called it the SPDR. It's SPDR. And people that know stocks call that one the SPDR. The NASDAQ trades under ticker symbol QQQ. We call that the Qs. So if I ever accidentally just reference the Qs, we're talking about buying the NASDAQ ETF. And if you buy ticker symbol DIA, we call that a diamond, and that's buying the Dow Jones Industrial Average. So just to give you, you've got the SPDRs, the Qs, and the diamonds as 3 big ETFs. Interest rates are going up, so investors are heading into fixed income. Quip Tim Holsworth, president of AHP Financial Services. We are and have been minimizing our fixed income holdings for the past several years, Mr. Holsworth said. The investment company Institute, whose data combines flows into mutual funds and ETFs, also shows a steady trend of investors fleeing equities and migrating toward the perceived safety of bonds. For the week ended last Wednesday, ICI reported $5.5 billion worth of equity fund outflows, which includes $7 billion of outflows from domestic equity funds and $1.4 billion of inflows into world equity funds. Bond funds, meanwhile, saw $3.5 billion worth of inflows during the week. And it goes on, by the way. But I think the point's already been made, guys. Why are we moving into bonds? Like, if you want to move out of stocks, okay, I don't get it, because you got to be right twice playing that game, right? You got to be right when you choose your time to go out. But not only that, you got to decide when to put it back in. And studies show that you can be right once, but trying to decide the right way to get back in, you end up losing a lot more than if you just ridden. And make sure that your goal is long enough that you can afford to ride. And by the way, there's a lot of people out there that think, well, why would I ride that? What if the stock market doesn't come back? Realize what stocks are. Stocks are a measurement of public companies' participation in making money or not. Over a long period of time, if companies don't make money, who cares what happens to the stock market? What happens to the economy? The economy is all on the backs of whether companies make money. So if you believe that the stock market isn't going to come back in 7, 8, 9 years after a downturn, then you kind of believe that you just need to get some guns and some food and move to the woods, because the stock market really is a reflection overall of the economy, and not always on par with the economy, but directionally over long periods of time. That's the way it works, folks. And if you're going to be invested in the stock market, you're betting that the economy over time is going to continue. So, moving into bonds. Why we move into bonds right now? Because everybody's been told stocks go up, bonds go down, right? There's this teeter-totter. Stocks go up, bonds go down, bonds go up, stocks go down. That's not the teeter-totter. People get the teeter-totter thing wrong. There is a teeter-totter, and the teeter-totter works this way. It's bonds and interest rates. As interest rates go up, bond prices go down. And as bond prices go up when interest rates go down. Which way are interest rates headed now? Interest rates are headed up, and they're going to continue heading up. And why do we know that? It's because the Fed chairman already told us. And around the world, we're seeing interest rates go up. And yet, we're taking our money and we're taking it out of a place with perceived risk, and we're putting into a place with real risk. And this is the key lesson, I think, in article number 2 here. And that's this. There's multiple types of risk out there. I'll give you an example. One of the biggest risks that people think about all the time, of course, is the stock market. And when they take money out of the stock market, they forget about, in this case, interest rate risk. Some people might be listening to this and they go, oh, good point, Joe. I could lose money in bonds. So here's what I'm going to do instead. I'm going to move my money into my savings account. Let's look at that type of risk. If you have money in a savings account earning 1, you look at Magnified Money right now, the highest interest rate is 2.2. So if we say, okay, we're doing really well, and we're in the 1.5 to 1.8 range. Not most. If you've got a brick and mortar bank, you don't have that. You're getting 0.5. But if you've got 1%, 2%, and inflation's at 4, you're still losing money. So there's inflationary risk. There's all kinds of different risks. So I think before you move from one asset class to another, I think what I do instead is take a look at my goals, see which types of investments historically have reached those goals, and sit. It's the safest way to get there. It's the best way to get there. And then I'll tell you what I try to do. When the market goes down, I look at how do I jump on that and make more hay, right? How do I make it rain money when the market's going down? And I'll tell you what I do instead. I try to free up cash flow and get even more aggressive with my asset allocation. So as things go down, what goes down the most? The most aggressive positions go down the most. And then the less aggressive positions go down the least. I want to invest more money into the more aggressive piece of my portfolio that's losing the most. Now, if it's an individual stock, let's say I'm investing in Sears, might not be a great idea. Not a recommendation. I'm just saying, that's my personal opinion. If you're investing in Sears, it might not work that way. But if you're investing in a diversified collection of investments, why not go with small, risky companies that are losing their butt? you're investing in maybe 500 of these companies at one time, maybe 1,000 by having an exchange traded fund. Invest in that marketplace that's super volatile as it's down. And what do we know? Reversion to the mean happens. If the economy is going to continue, it's going to come back. And if you get more aggressive as the market goes down, instead of doing what most people and getting less aggressive, you're going to make good money. Things are going to go very, very well for you. Historically, it's worked that way. And it's hard. It's so hard. Experienced investors say that, and this is a horrible phrase, there's one big investor, and I'm not going to get the name right now, who said that the best time to invest is always when there's blood on the floor. And that's a horrible phrase. But he makes a point, which is when everybody else is panicking and you've got the guts to go in, even broadly diversified. But remember, you're going into places that are long-term investments. Don't go in hoping for, to make money on a 1-2. Never go into stocks if you've got a 1 or 2 year time frame. I think that's a bad way to do it. All right, that's our commentary on piece number 2. Let's go back and say hello. We do this in front of a live Facebook audience, which makes me nervous and is half the fun of the show anyway. Chris says, kind of reminds me of the November 7th, 8th, 2016 trades or the Brexit trade or this February, short-term vision or fear, whatever it is. Yeah, Brexit. Great point, Chris. I mean, you saw as we went into Brexit, tons of people sold and within days it was back. Monster volatility and the market came roaring right back. And yet, we talked about studies during our headlines in the Stacky Benjamin show. People lost their butt. Financial advisors lost their butt because they told people, oh, it's time to get out. Time to get out. And then by the time they realized what they'd done and they were losing money, they ended up costing people a ton of money instead of helping them win. Arnold's here. Arnold says, just another example how individual behavior impacts personal finance and investments. Amen, brother. I totally agree. Glad you're here with us, Arnold. Good stuff. Hey, let's talk in just a second about the big idea. Coming up next, the big idea on this show, and that's where we take both of these headlines and we talk about exactly how we're going to put these together. How are we going to put Sears together with not going into bonds? I've got that for you in just a second. But I wanted to draw attention one more time to the tour. Big piece of the tour we haven't talked about much, which is one of our sponsors, TIAA, is doing something really cool. They're not talking about themselves during our tour. They're talking about, they're celebrating 100 years as a nonprofit by shining the light on people who are doing great work in the different communities they serve. So just so you know, TIAA is a company that was founded by Andrew Carnegie. He wanted to make sure that teachers didn't retire destitute. And because of that, he helped set up this nonprofit company, TIAA, which has helped tons of smart people, a lot of them working for universities, schools, hospitals, and other, a lot of higher ed people retire, but certainly even more than that. They've had such a broad approach. And as the company has grown, that mission, though, has stayed the same. I like their attention to fees. I like their attention to detail. I love some of the innovation they're doing alongside other companies like Blueprint Income when it comes to annuities, blowing up that segment of the market. But they're not focusing on any of that they were 100 years ago. They are shining the light on people that are making a difference in their community. And in each of our 3 shows, we're going to do a segment where we're not going to talk about TIAA. I'm doing that right now. We're going to talk about these difference makers in Orlando, in Kansas City, and in Detroit. And a lot of these people, a lot of these organizations have a national reach so that even if you're not at the live show, these are going to be organizations that are doing great work that helps out possibly in your community. StackyBenjamins.com/tour for more. And as I said, they're here with us today. The Money Millhouse gang is also going to be there, along with Paula Pant helping us answer listener questions in the audience and a lot more. Tons of stuff. StackyBenjamins.com/tour will show you the whole thing. Lots of segments in that show. All right, it's that time, folks. It's time for our big idea of the day. So how are we going to take these two pieces and put them together? We started off with Sears and Eddie Lampert complaining about pensions. And yet Eddie and company, Mr. Lampert and company, I should probably call him, I don't know Eddie, but he knew ahead of time that the pension obligation existed. And so profit or loss is usually determined at the point of purchase. And so when you make a transaction, don't just look at the short-term opportunity. Eddie now has owned this company for a long, long time, and yet he's saying now that pensions are a problem. Pensions have always been a piece of Sears. So I don't understand that. The second piece was advisors telling clients, don't flee stocks or bonds. You're getting rid of one perceived risk that you think is coming into a risk that is really, really real and is happening right now. Bonds are not a phenomenal place to be. And our takeaway there was there's multiple type of risk. But the big advice, and this is the big idea from both of these stackers, is that when you look at investments, when you look at your personal situation, when you're deciding whether to make an investment or not, pull back. We have this innate ability, which ain't very good, which is to focus really hard on one little leaf of one little tree and to get obsessed with that. And by the way, when I was an advisor, I would work a lot with engineers, and engineers were phenomenal at detailing the leaf. And sometimes I would have to go deep with them on how that leaf worked and how things were, just so they knew that I could go that deep. And then I'd tell them, I'd say, you know what, that's irrelevant because that's a leaf. I don't just want to look at the leaf. I want to look at the limb of the tree. I don't even want to look at the limb of the tree. Let's look at the tree. Actually, let's pull back even farther and let's look at the forest. Because the forest is, you're worrying about the difference between 0.5 and 0.3% on your investments. And the reality is the reason you're not retiring is because of the fact that you haven't saved any money. The forest is save more money. The leaf is do it in investments that have responsible fees. That's the thing. Eddie's looking at a leaf. Maybe he looked at some other leaf while he was making the investment decision. I wasn't in the room. I have no idea. But when Sears Holdings made all of their decisions, this pension obligation was already there. You don't want to make the mistake Sears made. Make sure if you're, especially with things like real estate, individual stock decisions, evaluate the whole forest instead of just that one tree. Instead of just that one leaf, even. One tree is better than one leaf. It's the same thing on our second piece. People are so afraid of stocks right now that they're moving into a different area. Yet, if they were thinking about a broader definition of risk, they'd realize that they're getting into a real risk and away from a perceived one. Big idea. Don't focus on one leaf. Zoom out, look at the whole forest. And that's our takeaway today, guys. Hey, thanks for playing today, everybody. Everybody hanging out with us on Facebook, everybody at home. Thanks to everybody, by the way, who's left a review of this show. This show's been climbing up the charts. We're in the top 100 podcast in our category on iTunes, or Apple Podcasts rather, which is the investing subcategory. And even though I'd say we're not really just an investing podcast, that's the closest thing to us. By the way, thanks to NYPD1, who left a review. Mom's putting this on her fridge. NYPD writes, great podcast, 5 stars. Joe is an excellent podcast that gets to the point. The podcast gives you 2 topics and doesn't make it long. Joe teaches you in a fun, concise way. The show always has an interesting format. Keep those shows coming. I always look forward to them in the morning. Well, thanks, NYPD. We love having you here. Guys, go stack some Benjamins. We'll see you next time back here at Money in the Morning.
Money in the Morning is created by Joe Seul-Sehy and comes to your ears because of the collective genius of our producer, Richie Rutter-Reese, engineer, Caden Thompson, and a pack of very well-trained ferrets here in the basement. You'll find links to all of our headlines featured on today's show in Joe's Twitter feed at @AverageJoeMoney. I know you already know this too, but Money in the Morning is for entertainment purposes only, and you shouldn't act on anything recommended by a bunch of entertainers in a basement without first consulting with your financial advisor and second, having your head examined. Have a headline you'd like us to discuss? Send them to Joe at stackingbenjamins.com or put them on our Stacking Benjamins Basement closed Facebook group. This show is copyright 2018 Stacking Benjamins LLC, all rights reserved. I'm Joe's mom's neighbor Doug, and I reserve the right to always say, we'll see you next time back here on Money in the Morning.